Good morning, everyone. Welcome to our program. I'm super excited by the webinar that we have teed up for you this morning. Excuse me. Welcome to a special Private Equity Career News webinar, Trending Origination Strategies for 2024. My name is David Toll. I'm the publisher of Private Equity Career News, and I'm going to be your impresario and moderator for the program today. I'd like to start out thanking our sponsor, SBS by Bain & Company. They are an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing efforts. A few housekeeping announcements before we get started. First, a friendly reminder to any reporters on the program today that we are off the record. So please reach out to the speakers individually for permission if you would like to use anything that they say today in an article. Second, you can download a copy of the slides from your control panel. So no need to take extensive notes unless you really wish to. You can also download a copy of the results of a 2023 survey of business development professionals. It includes valuable information on industry practices. Third, later today, expect to receive a link to the recording of the program. And finally, I know many of you asked questions when you registered for our webinar. We will plan to address those questions during the roundtable discussion portion of the program. However, please also feel free at any time during the program to ask questions using the question feature on your control panel. And we also will save about 10-15 minutes at the end of the program for a pure Q&A. So I'm grateful to have 4 expert speakers today to help us navigate this topic. Clay Bryan is a Los Angeles-based Senior Managing Director of the Financial Sponsors Group at investment bank B. Riley Securities. Daniel Gajewski is the New York City-based Director of the Sponsor Coverage Group at investment bank Lazard. Dan is dialed in from Vail, Colorado today. Stephen Madsen is the New York City-based Managing Director and Head of Business Development at buyout firm Blue Wolf Capital. Blue Wolf is well known for its love of complex deals and situations that scare away mere mortal investors. And finally, we have Nadim Malik, founder and CEO of New York City-based SBS by Bain & Company, our sponsor. After introductions, I'll pass the baton to Nadim, who will present some statistics describing the state of the M&A market. Nadim will also address the role of technology in helping deal originators see a higher percentage of relevant transactions. Let's find out a little bit more about our speakers, starting with Clay. Clay, tell us a little more about B. Riley Securities and your role there.
Sure, thank you, David. And Nadim, appreciate Private Equity Career News and Sutton Place for having me today. So B. Riley Securities is a 2,000 employee diversified financial services firm. We're headquartered in Los Angeles, have offices around the world, but large presence in New York City, Chicago, and Dallas here in the States, and then London and across Europe. Overseas, we have the majority of our businesses, B. Riley Securities, which is a small cap, mid cap advisory firm and underwriter in the equity capital markets, public equity capital markets. We have a large M&A business, of which about a third advises private equity firms. So we're verticalized across the industry and cover about 400 names in terms of writing research across industry. So I lead the sponsor coverage practice within B. Riley Securities, been in banking for 23 years, was an execution banker in M&A and leveraged finance at bulge bracket firms and middle market firms alike, before dedicating 100% of my time to covering sponsors like Mr. Madsen.
Super, thanks, Clay, and really appreciate your getting up early to join us from Los Angeles. All right, let's turn to Stephen Madsen of Blue Wolf. Stephen, tell us a little bit more about Blue Wolf and your role there.
Good morning, everybody. Thanks for having me on. Thanks, David and Nadim, for organizing this, and my friends Dan and Clay here for joining. So Stephen Madsen, Managing Director and Head of Business Development at Blue Wolf Capital. Blue Wolf Capital, we are a 2.9 billion AUM private equity firm based here in New York City. We're downtown. If you think about us, we certainly have some history and complex situations. And really the founding niche of the firm, or the heritage of the firm, is in deals that have government or union exposure. Over time, as we've gotten to know different industries, we've really transitioned into being more of what I would call a sector expert investor, where today 50% of our portfolio is in industrials, and that breaks down across niche manufacturing, forest products and building materials, and then industrial engineering services, and then across healthcare, where today we're invested in 6 companies across healthcare services and medical device and technologies. Currently investing out of our 5th fund, which we raised for $1.1 billion in April of 2022, and looking for interesting investment opportunities across our whole investable universe.
Thank you, Stephen. I imagine there's no shortage of complexity out there in the market today. Dan, let's turn to you with Lazard. Dan, tell us a little bit about the firm and your role there.
Perfect. And like the rest, thank you, David and Nadim, for putting this together. I'm happy to be here. Lazard Frères is a global investment bank. We have 2 different divisions. One's an asset management group, and the other, which I sit in, is the M&A advisory practice. We've got, I think we are now at 41 offices in 20 countries. I sit within the private markets advisory practice, which is typically dedicated to dealing with private transactions, versus some of my large cap colleagues that tend to cover the large deals and work on things like the WestRock big top of the fold Wall Street Journal mergers. I've been with the firm for 6 years, came over from institutional equity sales at Piper Jaffray, now at Piper Sandler, and I focus on covering private equity firms on the East Coast, typically between like 350 million AUM all the way up to 10 billion of AUM. So thanks for the opportunity.
Fantastic. Yeah, that's quite a broad span of deal size. So I'm sure you're seeing a good portion of the market over there. All right. So with that, I'm going to turn the program over to Nadim Malik of SBS by Bain & Company. Nadim will introduce himself and present some data to shed more light on the current state of the market. Nadim?
Thank you, David, and thanks everyone for joining us this morning. For those of us in the Northeast, hope everyone's enjoying some more pleasant weather after a rough last week. At SPS by Bain & Company, we're continuing to do what we specialize in, which is helping our clients position themselves for relevant deal sourcing opportunities in the current market using data, analytics, technology, and automation. You know, we do this panel every quarter, and I wanted to share my opening comments from the one we did exactly 1 year ago. Quote, given the slowdown in deal activity in the second half of last year and overall market performance, recession fears, etc., I think a lot of people were looking forward to turning the page on 2022 to kind of just put it behind us. Many were expecting things to change, whether it was an uptick of deal flow, signs of the Fed changing its policy on interest rates, etc. But are things changing? If so, for better or worse, or are they pretty much where they left off last year? End of quote. Well, I don't know about you guys, but I'm getting some serious deja vu. Did anything happen last year? Or it feels like we're in the exact same spot. Or are we? Well, I'm really looking forward to hearing the perspective of our panelists, who are great at what they do and have been doing it for a while, each of them grappling with many of the same questions as our audience. But before turning things over to them, I wanted to spend the next 8 to 10 minutes walking through some slides to help frame our conversation. Starting with what you see in front of you here, the overall private equity and M&A deal volume. As of right now, deal activity has declined by just under 20% in 2023 compared to a 14% decline in 2022. Having said that, once the dust settles in 2023 deal data, since we're continuing to receive deal announcements on stuff that closed last year, the percentage decline will likely come in closer to around 15%, or in other words, very similar to the prior year. It's also worth noting the trend that began in 2021 of PE representing a larger share of overall M&A activity compared to strategic buyers has continued for the last few years, and PE activity represented 54% of overall deal activity for the last year compared to 53% last year. So a slight uptick there. With more financial investors and PE funds continuing to pop in, I'm wondering if this trend's ever going to reverse. Let's see. Moving on to the next slide, which breaks down the same deal volume data quarterly, it's pretty amazing to see. You can see the climb up the mountain starting from its base in Q2 2020. Not to bring back bad memories, but that was the beginning of COVID, to the summit in Q4 2021, and then downhill trend since then. Deal activity in Q4 2023 was down 21% compared to Q4 2022, and is down 45% from its peak in Q4 2021. Now, keep in mind those percentages will decrease as more closed deal data is discovered for the last quarter of the year. Moving on to the next slide, here's a look at the most active sectors over the last 3 years, broken out between strategic and PE buyers. Industrials continues to be the most active sector, but is currently down 19% compared to last year, after actually increasing in 2022, interestingly. Followed by the technology sector, which is down sharply year over year for the last 2 years, and business services, which was also down in 2023 after coming in more or less consistent for the prior 2 years. The sectors with the least decline year over year are healthcare and energy. PE has the edge over corporate buyers in all of the top 5 most active verticals, while the financial services, energy, and media and telecom sectors saw a higher share of strategic versus PE deals. Moving on to the next slide. The trend of the buy and build and roll-up strategies in private equity continues to increase, although only slightly in the last year, reaching 2.6 add-ons for every platform after coming in at 2.5 add-ons for every platform in 2022. While firms are still completing add-ons at a more accelerated pace than platform deals, according to our 2023 Dober analysis, which came out in October, add-ons fell by 40% from the latest year compared to the prior year. Having said that, I will say that we're continuing to see more of our clients get more involved in their add-on sourcing instead of just leaving it to their management teams of their portfolio companies. Moving on to the next slide, which focuses on private equity activity only and breaks down that activity by sectors into the 4 deal types we track, which are add-ons, buyouts, financings, what we call non-change of control transactions, and recaps. The 3 top verticals are business services, healthcare, and financial services. The 3 top verticals in terms of add-on activity were those 3 verticals relative to other deal types. While financings or minority transactions continue to remain an important investment strategy in the technology sector. Having said that, add-ons comprise the bigger share, if not an outright majority, of all transaction types for most sectors, and are the key contributor behind PE activity representing a higher share versus corporate buyers of overall M&A activity for the last 3 years. Moving on to the next slide, let's look at private equity pipeline data, the deals that they're seeing. The median number of deals that PE firms saw, or perhaps more accurately logged, was 162 in Q4 2023. Significantly less than the prior quarter, which shouldn't be a surprise given how the fewest number of deals tend to be brought to market in the last couple of months of the year, and just slightly less than Q4 2022. While these numbers can't speak for quality, it does seem like pretty decent deal flow numbers purely from the perspective of volume and not a major decline year over year. Moving on to the next slide, there's a lot going on in this one. So let's just start with the top right, which shows the most active PE firms in terms of new platform investments and exits last year. So pretty straightforward. On the top left, privately held companies continue to represent around 2/3 of all platform investments made by PE firms, while private equity portcos as a percentage of seller type have declined from 30 to 23% over the last 5 years. And finally, on the bottom left, the split between corporate buyers and PE buyers when private equity firms are exiting their portfolio holdings more or less was consistent in 2023 compared to the prior year, just slightly more favorable towards private equity buyers. Moving on to the next slide. Here we're showing the top intermediaries that sold businesses to private equity firm buyers only in different size ranges in the US and Canada last year. It's amazing how much it can vary just by this one filter, private equity buyer and size range. It's a great reminder how misleading it is to just rely on published generic league tables or uncustomized data to determine how to prioritize your time from a sourcing perspective, whether it's intermediaries or sponsors. You really need to have it sliced by sector, geography, control versus minority, special situations, and even broad versus limited processes if that's important to you to get the right target list for your market. And then if you can layer on top of that the deals that you're seeing and calculate what your market coverage is and share of mind for each of these intermediaries is, it can really eliminate a lot of guesswork and save a ton of time to prioritize your outreach. Moving on to the next slide. Direct to sponsor sourcing has become a core part of our firm's value proposition for clients. And according to our data, there are about 5,100 platforms that were acquired by PE firms between 2012 to 2019 that are still active, and logic dictates we'll need to trade again soon. Our clients are able to sift through all the granularity of these portfolio holdings by deal size, sectors, geographies, maturity, the PE professionals whose portfolio it's in, their contact data, even potential warm intros to them through this connections functionality we have. And it really helps them get smart and more proactive on this sourcing channel. Now, building on the theme of the previous slide that you need to be able to carve out the data and direct your sourcing efforts in a customized manner, in this slide, we've cut the data to look at larger transactions where honestly, direct to private equity sourcing tends to be most prevalent. The mini chart towards the center of the slide shows that PE hold periods are continuing to extend. This should be no surprise based on all the data and commentary we're hearing about PE firms in a wait and see mode regarding selling their portfolio companies. The chart on the left breaks down larger assets currently being held by sponsors by our third level industry taxonomy, which as a reminder has 4 levels with the final level comprised of 500 categories. And the chart on the right shows the top PE firms in terms of larger assets that are being held, that have larger assets in their portfolio, further broken out by vintage. The next slide shows a different theme within sponsor sourcing that we're seeing come up a lot, which is a focus on assets that have been held for a longer than usual duration. Perhaps they're distressed or have some kind of story behind them. Perhaps there's an angle or urgency on the part of the sponsor to sell. Well, this chart on the left breaks down assets held by sponsors for at least 6 years or more, further broken down by vintage by our level 2 industry taxonomy. And the chart on the right shows the top PE firms on these same assets, further broken out by vintage. Moving on to our next and final slide. This is a shameless plug. Every Thursday morning, we have a newsletter that goes out called The Source. Sometimes it's a written piece, other times it's a video interview. We try to cover our top strategies, tips, and tactics being used by PE and M&A professionals that we respect. Other times it's market trends from industry experts, and yet other times it's just the latest reports and insights that we publish. So it does tend to be very well received, and we do it every week. You can go to the address at the bottom to sign up and make sure you're on the distribution list. With that, I'd like to turn it back to our moderator, Mr. David Toll, and our panelists for our discussion and Q&A.
Thanks. Thank you, Nadim. Nadim, I have a question for you. It did seem to be a sort of a dichotomy or a contradiction between, the sort of slowly falling off deal volume, but yet the deal pipeline is, remained relatively strong. So what accounts for that? What's going on there?
Yeah, I think it's a really good observation and question, David. What we presume is happening is deals are, the business development and deal sourcing practice is getting better and better. So investment banks and intermediaries it's easier for them to have a broader reach on the types of deals and the deals that they're bringing to market. And on the same side, private equity firms have BD professionals, different data and technology tools. So the way that we explain that, and I think this is consistent with the conversations we have with our clients, is that while the number of closed deals is not only not increasing, it's decreasing, those deals are showing up in more and more pipelines of our private equity firms, number one. And then the second factor is, if we do this analysis called the science of deal sourcing every spring, I think a lot of deals that are coming to the market, a higher share certainly than in a normal period, are getting stalled or don't end up happening. So I think it's the combination of those two factors where you see, deal flow that shows up in private equity firms more or less flat or only slightly down, whereas a much sharper decline in actual closed deal volume.
Yeah, I would just add to that, David. It's a really good question. I think there's a couple of things happening. One, there are deals that have been engaged but are quote unquote in inventory, are not, have not been brought to market but have been under engagement for some time to do just that. And that's a function of instability in the macro environment, which I think is increasingly stable, and we'll talk more about that today. So I think you'll see some of those deals begin to come to market. And then I think there's, to Nadim's point, there are probably deals that were in some of the prior year data that may have showed up in this year's data because they didn't close a couple of years ago or a year and a half ago, and now they're coming back to market. There's quite a bit of that out there today.
Okay, yeah, that does help explain things. So let's move on to a polling question. I want to take advantage of the fact that we have a very large audience today, try to get some market intelligence on the outlook for deal volume for the rest of this year. So if you give me a moment, I'll tee up the poll. So the question for you to answer is, how do you expect the number of platform deals to compare this year with last year? Might take a moment to launch. Okay, so go ahead and vote. Your options are down from last year, even with last year, up to 10% higher than last year, or more than 10% higher than last year. All right, well over half of you have voted, so I'm going to close the poll and share the results. All right, well, I don't see the results on my screen, but I'm hoping that
we can see them, David.
Yeah, David, we can see them, and it's basically saying 90%, more than 90% are saying they're either going to be even or up compared to last year. So that's the takeaway for me.
Okay.
Yeah, specifically even or up to 10% higher. 13% said more than 10% higher. Roughly the same said down, which is sort of what I would have expected. You know, I think people are somewhat optimistic in general, and certainly we are, based on what we're seeing in our business.
Okay. So it sounds like, and I do see the results now. So lots of optimism out there about a turnaround for deal volume this year for platform transactions. Okay, so let's, with that as a backdrop, let's get into the roundtable discussion portion of our program. And with this first question, I would like each of my panelists to take a stab at the question in turn. We'll start with Clay, and the question is, what is the quantity and quality, especially quality, of deal flow out there right now, and tell us what you're seeing, Clay.
Yeah, I think that the quantity and quality are both up in terms of what we're seeing, and I'll just speak to what we're seeing inside of our business. Pitch volumes in the last 45 or 60 days have been up about 4 to 1 versus comparable periods the prior year. The mix of private equity sell sides is significantly higher than founder-owned sell sides. So as I mentioned in the beginning, our business is roughly 30% sponsor represented and 70% founder owned. And right now we're seeing kind of a 50-50 mix. I think that's indicative of the market more so than, you know, just us growing at some extraordinary pace. So I think a combination of high quality sponsor sell sides that are, you know, by definition a little bit larger than you know, an ordinary founder owned kind of lower middle market deal. And some of the businesses that have been waiting for a market opportunity to come to market because they're going to command a higher valuation. They're patient enough to wait until the right entry point in the market to pursue a sale. I think those are starting to loosen up and come to market as well. So I think that does two things. One, that increases volumes, and I think that it also increases quality.
And Clay, what's motivating private equity firms to sell right now? What's behind that?
I mean, it gets back to, I think, a stabilized macro environment, and I think, you know, so you've got macro and then micro, and I think those two are converging in a more confident way. You can't sell a business that doesn't perform sequentially during a process and that has good visibility into the next 12 months. After a private equity fund or a corporation buys it. And that's Stephen and I would spend, you know, a lot of our time talking about visibility in the next 12 months when we're looking at a deal together, and I'm sure Dan does as well. So those two things have to come together, and I think sponsors are seeing that that dynamic play out in their portfolios. The relative health of those businesses is still there. And that combined with a more stable macro environment, and I think some optimism around the rate environment, the cost of capital is really driving it. I also think that there's a little bit of you know, pressure in terms of recycling capital to limited partners. A lot of fundraising still trying to happen, and to do that, you need to have some monetizations, and so I think that that's out there, you know, and is somewhat of a pressure, but it's really, I think, fundamentally just a better deal making environment that we've seen really just in the last quarter.
Okay, so that certainly contributed to a more optimistic picture as we get into this year as well. So Dan, you're also on the investment banking side of things, seeing a broad swath of the market. So tell us, from your point of view, what's the quantity and quality of deal flow like out there?
Yeah, so I'd echo a lot of Clay's comments. Of course, we're both in the same business, chasing the same deals. So it is pretty robust backlog for us of deals to bring to market. And the reason for getting into market is the business's performance. So pretty hopeful with 23 being a relatively good year for most businesses if they're able to manage the human capital components in the inflationary environment that we've been in. But I would zoom in a little bit on what Clay ended with the LP dynamics. So Lazard has a large private capital advisory group that is in the fundraising business. We also are a market leader in continuation vehicles and secondary sales for LPs and GPs. And that, I think, is driving a lot of the catalysts for private equity to get back in market, because LPs are highlighting, like, it's been 2 years of net outflows for them in the PE space. And in order to raise the next fund, you've got to return some capital. 23 was also the year where valuation, there was a little bit of a valuation disconnect between where either the marks were or what the private equity or founder wanted to get for their business. And valuations changed because capital costs more. So there was a seller expectation that was much higher than what the market would bear. So to Clay's point earlier, many businesses just didn't transact. So we have worked on really driving more of a curated process, maybe a longer pre-marketing process for some of these larger assets, and then launching more broadly. So that's kind of what I'd say on that. But general quality has been pretty good. Lazard has been pretty focused on like the technology, industrial tech, like the high growth areas of that private equity is interested in. So that's where we've been focusing, and it's been good.
So Dan, you mentioned that you have a group there that works on continuation funds, part of this growing secondary market. Can you speak to whether that's providing like a real option or a popular option for private equity firms versus selling their companies outright? Like, how much competition does the continuation fund market provide to the traditional M&A market?
Well, the continuation vehicle market is really currently reserved for your A+ or trophy assets that you're hoping to own for a lot longer. We helped kind of change the market from, it used to be the legacy assets and older funds, and then that fund was coming to a close after its 10-year life, and you need to do a continuation vehicle to close that fund. But private equity's got a little bit of a conflict where it's very hard to get winners that are going to be 10x, but you're incentivized to sell that to have a mark in your IRR and performance of your fund. So this solution has come in as a large pool of capital has been raised to be dedicated to secondary investments. So it's a new asset class that's coming in, and if it's an A+ asset that has all the good characteristics of a business you'd like to own for a long time, you can get the liquidity for your LPs. They can choose if they want to take it or not. If they choose to roll, you're then rolling your GP stake into the continuation vehicle, and you could own that for a longer period of time while getting a mark in your current fund without truly losing the opportunity and upside. So I would say that it's in competition, but only for A+ assets. And the valuations can be very different, right? So it's usually at or slightly below where the mark is, whereas when you sell an asset completely, it's clear and free and typically above the mark.
Cool. Thank you, Dan. So Stephen, let's turn to you. Same question. What's from your perspective as a private equity sponsor, deal maker, what's the quantity and quality of deal flow like out there right now?
So I'm cautiously optimistic is how I would characterize it, about the quality and quantity of deal flow in 2024. I think very much in line with your poll results. And I would point out actually that very few PE firms do more than 10 platforms a year. So increase of 10% is probably saying flat with a little optimism. So it's a, that's where I am with it too. I think we've been hearing sort of the unsold inventory. I've been hearing the unsold inventory story from the banks, really, I think now since the end of 21. It's a long-standing story. I think there are a lot of banks that have mandates engaged, whether it's a sponsor that wants to prep something early, whether that's a family founder that for one reason or another is always on the verge of selling. And these mandates continue to trickle out, and I think sometimes they trickle out in very small batch processes, which then people don't necessarily count. We talked to 2 buyers on a one-off, but we're not gonna count that. But I expect a lot of those assets will finally come to market this year with the interest rate environment getting a little better, and frankly, with people just looking at the clock and saying, if I'm going to do something, I need to do something. So I'm hopeful that we'll see some continued momentum and deal flow into 24. I think we saw some nice pickup in Q4 23 on our side, and optimistic that'll continue.
And
David, just to touch on, just to continue to touch on that for a moment, is additionally the farther we get away from the 2020, 2021 numbers, the better investors can assess leverageable cash flow and like stability of cash flow. So that's also every year that we get past COVID, and COVID being in the 3-year numbers is generally more optimistic.
And what about the potential impact on the M&A market of the November election? Nadim, any thoughts about how that might impact things?
How much time do we have? I think it's a very interesting topic if you get sucked into the news cycle at all, like I do from time to time. But historically, David, and I'd like to get Stephen and Dan's impression here, but election years typically don't have like an impact on closed deal activity. They seem to be insulated from what could happen. I mean, there could be instances where there could be a policy change or something coming out of it where people might want to pause certain deals. But historically, as we've looked at this, stock market could do one thing, there could be other things, but in the private equity and M&A space, it doesn't typically have an impact, and I'm not anticipating it, knock on wood, famous last words, to have much of an impact on the deal activity.
Dan, Stephen, any thoughts on the impact of the election?
I think Nadim commands the data better than anybody, and that's consistent with data I've seen. There's always pockets that could be impacted, but I'm not. I think not. It's not a core focus for me today.
All right.
I'd agree with Nadim on the point of it not really being a non-issue for the private markets. The only thing I would flag is that I've seen a number of pitches that dusted off the 2020 push on tax changes for founders. So you could see an uptick depending on what some of that looks like. I mean, we were pitching that in 19 and 20 to founders of a very simple analysis of, look, if taxes are this and you sell next year, you're going to lose 2 turns basically of your on your business to your bottom line. So that, depending on how that sounds, I would imagine some founders might be pushing things out, because we did see that uptick in 20 for sure.
Hi, David. Can you hear me? This is Clay. I've rejoined.
Yep, we can hear you fine, Clay.
Good. The only thing I would add to that is that I think the Fed's probably going to be more accommodative in an election year, especially given the environment we're in and have been in. So that's the only other color I would add to what's been said.
Okay. And Clay, a more accommodative stance by the Fed, is that good for the M&A market or neutral?
Yeah, I think what that means is that we're more likely to see rate cuts this year.
Right.
Which would stimulate deal activity, lower rates.
Okay, super. Let's turn to talking about specific industries and where we're seeing sponsor activity, where things are cooling off. And for that, Dan, let's turn to you. From where you sit, what industries and subsector trends are generating deal flow for private equity sponsors, and why are we seeing it?
Yeah. So, well, given how competitive private equity has become, and you can see it on every website for like the investment criteria, many subsectors are being added and are highly competitive spaces that people now need to be relatively experts in an industry to compete in processes. So, a lot of the areas that we've been focused on and where we've seen kind of the puck going, to use a hockey term, as around B2B services. So that's one of the highest areas, whether it be industrial, commercial facility services, healthcare services, any type of tech-enabled business service. That's one of the areas that's definitely still remained quite strong. I would say other areas where private equity is looking to play will be off of like the infrastructure bill or the CHIPS Act. So anything touching semis today is pretty attractive. We've had a number of deals in the space and are going to be launching a number of deals with just absolutely fantastic growth opportunities. Another area that Lazard's been focused on is the renewable transition. So anything on decarbonization, grid instability, green energy projects, engineering, procurement, and construction businesses touching those. That's been a pretty attractive sector. And then also value-added distribution. It's been very strong for the last couple of years, for sure. To your point on the areas that are cooling off, I would say it was reflected a little bit in what Nadim had, but if there was a cyclicality component to your business, I think that has cooled off a little bit, and we saw that with the downtick in industrials. And then I would say anything on the consumer product side and the D2C side, mostly because of what happened during COVID, and we saw a lot of those trends kind of revert to the mean again.
All right. Okay, Dan, that's a great overview. Dan, you said you're seeing a lot of activity in the transition to renewable sources of energy and green energy. I'm wondering, does that have a foundation beyond politics now? Because obviously administrations come in more or less friendly to green energy. Does this movement have a life of its own at this point?
I would say it does. The amount of capital that's being poured into renewables is not only by government incentive, but from the private sector generally is quite astounding. So I think green energy is here to stay. The general trends in electrification is here to stay, and populations continue to grow. So we're going to continue to need more power, and getting it out of the ground is still, to your point, a little bit of a political football, but that'll still exist as well.
Okay, let's turn to, thank you for that, Dan. And let's turn to the topic of pricing, and I'll turn to Clay for this. Clay, what do you think will be the #1 driver of multiples this year, particularly in software, but also speak to other other industries?
I think it kind of builds on my last remark, which is, more quote unquote accommodative Fed leading to lower interest rates, which can drive valuation, especially in high growth sectors like software. I think the public markets certainly are fueled by that, and that trickles down into the private valuation dynamics that we see. So I think interest rates is probably the single largest macro driver at a minimum, but without that, there's I think a challenging deal environment for any sector. And then I think if you drill down into kind of more micro by industry for software, I think the rule of 40 remains a good guideline. But what we're seeing from software investors that we work with, there's an increasing emphasis on growth. There's a lot of talk out there in the marketplace about growth should be weighted 2 times profitability, and so I think that's going to be in focus, both interest rates and overall growth, even more so than profitability. And then I think within the tech space, just to comment on a few other sectors that I think are going to continue to garner high valuation, just simply due to the growth in those segments is AI, cyber privacy, automation, enterprise software, et cetera. So I think those sectors within tech will continue to garner higher valuations, but I think there's going to be an increasing emphasis on growth going forward in software. Other industries, I think, really gets down to visibility and income. Not just revenue growth, but profitability and gross margin, but also in cash flow. I think whenever you have a challenged environment, people sort of revert towards the fundamentals, and I think cash flow, remains king across other sectors outside of software in terms of valuation, with an emphasis on predictability and visibility into that cash flow.
Okay, thanks, Clay. Well, let's turn our attention a little bit more toward individual companies and their performance. And for that, let's turn to Stephen of Blue Wolf Capital. As you look across your portfolio, Stephen, of companies that you've already assembled, what are you seeing in terms of their performance over the past couple of years?
Look, I think it's a great question. So as we've already touched on a little bit today, there are macroeconomic headwinds that we're seeing, just like everyone else: higher interest rates, inflation, growing geopolitical instability, whether that's the war in Ukraine, the threat to Taiwan, throw in the election year for good measure, elevated costs for labor, limited availability of labor, and kind of on and on. It's been a challenging environment. And then you have within healthcare specifically, there are always sector pockets that are facing reimbursement rate challenges as well. So as an investor, how do you navigate that so you can survive and thrive, frankly? And so I think, the way that you do that is by having kind of core theses and conviction that you can invest behind and that create resiliency. So for us, our focus on reshoring, which has been a core thesis at Blue Wolf now for years, has allowed us to stay ahead of many of those trends. I think when you look at what we do on the healthcare side, our focus on the triple aim, which is to say improving experience of care for patients, improving the general health of the population, and reducing healthcare costs per capita, moving care to the lowest cost setting. That's allowed us to build a portfolio that has a lot of resiliency built in a challenging environment. So it's been a good time to be an investor with a lot of conviction and a lot of in your investment themes and theses.
And Stephen, stick with you. Are you a buyer, a seller in this market, both?
So those who know me really well probably know I'm a little bit contrarian by nature. So I've always loved, I think it was Baron Rothschild who said, buy when there's blood in the streets. I don't know that there's blood running in the streets today. Certainly not the Battle of Waterloo, but I'm a net buyer in this environment. I think if you look at some of the data that Nadim shared, and we had a little bit of a preview of it over the last couple of days, if you zoom in on slide 6, that where you can see buyouts are broken out. Completed deals in 2023 were down 17% industrials. They were down 40% in healthcare. Out on top of that, PitchBook was out with their Q3 healthcare services report a couple months ago. I don't think I've seen their kind of year-end report yet, but as of the end of Q3, they had not recorded a single syndicated loan issuance in healthcare services for the first 3 quarters of 2023. And off the top of my head, I can't think of any for the last quarter, although I could easily be wrong. I know some are in the works. That to me, that says something about the state of the market, and certainly it's a challenge to persuade people in this market to sell. But it's a really good time to be putting capital to work, be finding opportunities. Nice time to have a relatively young Fund 5.
Okay, and Stephen, how big, just to give us a feel if you can, how big is your portfolio? How many companies do you have? And how many, might you try to sell this year? If you can give us a rough idea.
So we are today invested in 19 companies. And I think you forgive me, I'm going to wave off of the second part of the question.
Sure.
But the portfolio is 19 today, and the goal is always to be 50-50 industrials and healthcare.
Okay. Let's turn to the credit markets, which always play a critical role in the health of the leveraged buyout market. And Clay, how cooperative are the credit markets being? And give us a feel for what leverage multiples and terms are like.
Yeah, I think Stephen made a good point talking about the syndicated market, which has been all but off in the last couple of years. Made it much more difficult for larger deals to get done. That said, you can get $1 billion unitranche done with a direct lender, or maybe even larger if the credit quality is there. So I think for the middle market, broadly speaking, you don't really need the syndicated capital markets. But I do think that they are going to come back this year, along with the rest of the market from a, just a macro stabilization and hopefully declining interest rate environment. So with that said, what we're seeing in the middle market is that direct lenders have become, much more accommodating in the fourth quarter, along with the rest of the M&A environment. We had a couple of deals that were low teens enterprise value multiples that saw almost 50% leverage. They were, in the kind of 45 to 48% loan to value range, and priced on, grids where you had, a starting rate at 575 over SOFR, and that would decline as leverage declined. So I think that was a market difference from prior quarters last year. And so I think we'll expect to see that trend continue into this year. The market is really pricing in a kind of a 97% probability of at least 4 rate cuts this year. So we're 5.5% targeted kind of Fed funds rate today, could end the year, full point or so below that. I think the market's expecting 4.25 to 4.5. So with that trend, direct lenders, I think, are interested in putting capital to work again in the highest quality credits they can find. There's going to continue to be this kind of flight to quality and the haves and the have-nots, so to speak, in the marketplace. Although I think the market is going to broaden, so there'll be more haves in the market this year that will benefit from just an overall better macro environment. So I think that's what we're going to see this year is continued support from credit markets to help deals get done. One guideline that we're sort of hearing consistently is that, from a covenant perspective, that lenders, are solving for something in the 1.4 to 1.5 times fixed charge coverage ratio as a minimum. And so I think that's still a little higher than we've seen in more healthy markets like 2021, but is a market improvement from what we would have seen last year. And I think credit overall in the middle market, especially from direct lenders, it will broaden to kind of meet the demand of a growing M&A environment.
Thank you, Clay. And Dan, any further thoughts on maybe how sponsors are dealing creatively with the credit markets and managing to get deals done, either platforms or add-ons?
Yeah, so we have a team called our Capital Solutions team, which is our private debt capital markets, debt and equity capital markets group. And was speaking with him. Bill Scherer runs that group for us, and he was pointing to just adding a slug of preferred. If there's a challenge with an add-on or you're looking to refinance or whatnot, you can go and tap the private capital markets for a slug of preferred and get a turn or two of third-party capital into the deal. And the reasons for that are, either your fixed charge, your leverage reasons, or most favored nation clauses of needing to reprice the entire loan if you're looking to increase it. But that's kind of what we've been seeing. There was one very unique situation that we helped one of my clients with. where they were looking to make an acquisition in Norway, and we partnered with Arctic Securities to issue a high yield Nordic bond. So that there's capital out there in all kinds of different pockets around the globe.
Okay, we've got a couple of questions lined up in the queue, and we're coming up to the 15-minute left mark. So I want to encourage anybody that does have questions, please ask them now so that we can get to them. First question coming in is for Stephen. What are you doing to find needles in haystack? So I guess they're looking for your top tips and hacks in business development here.
That's a great question. So, when you're looking for a needle in a haystack in my seat, some of it is just about systematically being out in the market, talking to people, having conversations, and listening attentively for what comes back, listening attentively for the time when, someone in Dan's seat tells you, actually, my friend owns a business that might be an interesting add-on for your portfolio company. That's something that happened to me recently, where it's entirely outside of any process. It's quite literally a personal friend and a neighbor, and maybe there's somebody new, maybe there isn't, but there is a look that's really a needle out there in the haystack. Some of it comes to building theses and doing kind of targeted outreach as you do your industry work, as you understand different markets. And look, there's no substitute for cold calling, emails, getting out, going to trade shows, and pounding the pavement. You're going to be talking to a lot of people. And then some of it is really about applying judgment to what does come in. Sometimes a needle in a haystack is a poorly written book that maybe 100 people saw, but you spend a little more time with it, you understand a little better, or your firm does. So there's no kind of one answer. I think there's some really interesting things happening. I don't even know if everyone's using the term AI. I don't know if that's a term I would use, and I would say data scraping, collection, and analysis. There's some really interesting things going on for proprietary sourcing. Think about tools like SourceScrub, FinQuest, all those guys. They're doing some neat things to pull company data and allow a buyer to identify targets and call on them directly. And we've used SPS for similar outreach around sponsor-owned assets. But again, there's still a lot of questions, the same drawbacks with all proprietary sourcing. And do you have a willing seller on the other side of the line? So it's unfortunately, there's no easy answer. It's just a lot of work.
Well, I have to say that you mentioned the poorly written book, and with the advent of AI, there is no more excuses for a poorly written book. ChatGPT will take a poorly written book and in 10 seconds turn it into a masterpiece.
So that requires breaking your NDA and feeding your client's information to ChatGPT.
Oh, well, then Nadim has
to
solve this problem. There has to be.
We'll see with Microsoft Copilot if it gets a little better.
All right, so that's it for questions in the queue for the moment. I want to turn to Nadim to continue the conversation on AI. And Nadim, tell us how you do see AI impacting deal sourcing, especially kind of in the near future, over the next year or so. Stephen just mentioned some of the tools that they're using there, but how do you see things evolving?
I think it really depends on, CEOs and business leaders like me that also have the responsibility to think strategically and 5 years out or 10 years out. Service providers in this space, there's so much a private equity firm is going to be able to do in-house, and maybe, engaging consultants can be of value, whether it's deal sourcing or other areas of the business that can leverage AI. But certainly, it's an area that a lot of us CEOs that serve the private equity industry are trying to wrap our heads around. And so the quote that I like to use when it comes to AI is the best way to predict the future is to invent it. You know, and I know many CEOs, we network together, and a lot of them struggle because there's no playbook. Everyone wants to know, how can this help my business and help my customer? But frankly, there's no playbook yet. It's so early and the potential is so broad and unknown. It really reminds me of the wildcat days for oil and gas exploration, where you just kind of have to go out there, be willing to fail, try, be the first one, you know, do things, and you be rewarded. And what that translates into today is, like, if you're trying to figure out AI in two ways, and certainly we are, how can we create efficiencies or improvements in our internal process? For us, it's specifically making our data richer or more efficient to collect. And then how can I enhance the customer experience using AI? And so we're definitely exploring both, and there is no playbook. It's about signing up to trade shows, attending trade shows, talking to consultants, talking to fellow CEOs, reading industry, you know, rags and all those things, and you kind of have to figure it out. You know, it's a great opportunity. And I do think the ones that are going to apply it, even, you know, businesses, they don't have to be huge to leverage AI, but there's so many opportunities that they could offer their clients. I do think they're going to be, you know, they're going to benefit their clients and be rewarded as a firm. So, like, you know, PE industry is, I wouldn't say early adopters of technology and approaches, and but, you know, AI, the more I learn about it, and this is where it's great to have Bain as your parent and partner. You know, they're on the forefront and have partnerships with OpenAI, and they're on the cutting edge of all this stuff and trying to answer all these questions for their private equity firm clients. So certainly it's an area I think that we're looking at, and I think as you continue to explore, you're going to be rewarded for. But it is, if you're just kind of waiting for the playbook to be formed, I won't say it's going to be too late, but I think that there is a first mover advantage in some of these things. So it's not going to be next year. It's going to be a little bit longer, but when it does happen, I think it's going to happen quick. I'll say that.
Okay, thanks for that analysis and prediction, Nadim. Okay, we've got just about 10 minutes left, so please get your questions in if you have them for our panelists. And my questions will focus largely in those last 10 minutes on sort of the nuts and bolts of business development and becoming more effective at finding transaction opportunities. And with that in mind, Dan, I wonder if you'd speak to what new skills you see BD professionals needing to develop to be, you know, successful in the months and years ahead.
Well, with Stephen on the panel here, I'll definitely defer to him on some things. But what I would say is a little bit just continuing to maintain and manage relationships both internally and externally are the key components of a business development person from my perspective. Being able to add value to your partners and then help and work with and manage a good relationship with your counterparties, and then also going out and meeting as many business owners as possible. So whether that be going to different industry conferences that are focused primarily on different sectors and or don't have a lot of bankers at them, you know, or a ripe opportunity for you to meet with CEOs of businesses that will eventually come to market, or going to like maybe a TMA type event, depending on how your investment theses are and what the firm is focused on. Building relationship with restructuring bankers could be pretty valuable for any type of up and coming volatility. But yeah, Stephen, do you have anything to add to that one, you think?
Look, I think, you know, the skills involved in BD are pretty timeless. You need to be a relationship builder. You need to be highly organized. You need to be intelligent and able and educated and able to understand, you know, what you're looking at and have a sophisticated conversation about investments. You need to be able to cover your firm the same way that you cover the external world, so that you really speak for the firm when you're out in the market. I think, you know, looking ahead, I certainly think there's always been an advantage to people who understand technology within business development. I think that advantage will continue to accrue and will continue to be a focus for professionals who are joining. I think we are probably getting to the point where we're probably maybe past the point where just having a BD function is somewhat differentiated. I think now BD professionals are going to need to spend a lot more time thinking about what sets their firm apart. Prior life, I've listened to literally thousands of PE professionals give me the spiel on their firm, and I'll tell you, they run together in a hurry. So thinking about differentiation is going to be important. I think there's going to be a larger component of communicating with the market via things like LinkedIn. I think you've seen some firms do a nice job of getting out there and doing that, and doing other sort of more mass targeted messaging around their deal sourcing. But at its core, the skill set that makes for a good BD person isn't going to change anytime soon.
Okay, Stephen, we have a follow-up question from the audience, and they would like to know how you prioritize your time between the industry conferences that you mentioned that you go to, individual visits with business owners or deal source intermediaries, calls, Zoom calls. Give us a feel for what's most important to you, how you prioritize your time.
Yeah, so I actually a few years back wrote an article that you can find in Middle Market Growth I think it was called "In Person is the Essential Currency of PE Business Development," and that drew on a proprietary data set which was shared in the article that showed that there's a qualitative difference in deals that you get, whether it's on Zoom or on the phone, versus in an in-office meeting versus at a conference. And so while if you look in aggregate and say how many of my deals came from Zooms, that might be a lot of top of the funnel deal flow. If you look down the funnel and you normalize it, so that what's your conversion by type of interaction, by where did you have the first conversation around the deal, what the numbers show there is that we were roughly five times more likely to go to an MP, a management presentation on a deal that had an in-person in-office meeting, and 10 times more likely to submit an LOI, and something like 2.5 times more likely to go to an MP if the first conversation was at a conference. That's relative to the first conversation being on a phone call or Zoom. And so I think the prioritization comes down a little bit to how do you like working, what does your firm's budget look like, but at the end of the day, there's a trade-off. If you want to sit back and work the phones, you can do that, but you're gonna have to do a lot more calls. You want to be out in person. I personally think you build a higher quality relationship and differentiate your firm in the process. In any given, I start by looking at my travel calendar. That's kind of the first thing that I plan out for the coming year, and I think about what conferences do I need to and want to be at, and that's largely driven by the conference schedule. You can't move those, can't change those. You just got to figure out whether or not you're going. Then look at where do I need to visit that maybe I'm not covering in my conferences. Do I need to go? That could be spending a day running around Midtown doing meetings. It could be trekking out to LA to see Clay and his compatriots. And then within the time that remains, you're figuring out how you balance phone calls, Zooms, and importantly, internal and strategic projects for the firm. And you're always working on a lot of those, and it is important to cover your firm. So there's no perfect balance, but those are the factors to consider.
And Stephen, another question for you I know you do a lot in healthcare, a lot in industrials. Are there particular conferences that are your favorites that you always look forward to going to and to meet business owners? So
I'm a big proponent of the different industry shows. healthcare, JP Morgan is the big one. I spent most of the week, a few days back, out there with our healthcare team. We'll be at the Builders Show here in a month and a half with some of our other team members on our investment and operating team. I think it's a little bit varies by where you're looking. I'm also a big fan of the ACG, Deal Max obviously is a must attend, and some of the North Star events as well.
Okay, and Stephen, just yet another question for you just came in. Can you speak to your experience, if any, working with third-party deal sourcing service providers? I guess we're talking about maybe buy-side investment banks.
Yeah.
Go ahead.
I mean, they're a valuable part of the ecosystem. I've had experience working with buy-side to direct outreach, direct call groups for add-ons and talk to some of them about platforms. I've worked with some of the groups that cover sort of very, very long tail intermediaries, but will pop up if there's an unusually large deal with a very small intermediary that can actually has been quite valuable over the years. So they're an important part of the ecosystem, but there's no substitute for getting out there and doing your own legwork.
Okay. With the final 3 or 4 minutes, I'm going to ask each of the panelists in turn to do a little lightning round question. So keep your answer to just about a minute. And I want to hear about a favorite portfolio company in the case of Stephen, or in the case of Dan or Clay, a favorite company that you've represented in a sales process recently. And just tell us a little bit about the company and why you like it so much. And we'll go Clay, Dan, Stephen, and Nadim, you can have the last word you like. So Clay? Sure,
thank you, David. So I think one that stands out for me is a business that we sold late last year as a platform investment for a sponsor in the middle market. It was a high growth digital advertising business that had a couple of layers of value proposition, which is one reason why it stands out so much to me. They were serving small and medium-sized businesses with sort of white label digital advertising campaigns. So the customer acquisition model for SMBs went through the agencies, which was a real distinctive value to the business itself and drove a lot of the growth. But they also had a software solution that kept the customers in its ecosystem and delivered another layer of buying power through that. So there were just multiple value props for the customers, which inured to the company's benefit and drove growth to a pretty high degree, and we had a great outcome on that business. So I'm really excited to see how that business performs in the next 3 to 5 years.
And Clay, can you tell us the name of the company?
I can't at this point. Not fully announced yet.
Okay. Well, we'll look for the announcement. And Dan,
my
favorite company?
My favorite deal last year, my favorite deal that we've done was last year we sold a business called MEI Crating and Rigging to Olympus from a family office that I had spent some time with. A pretty sizable transaction, over 500 million of enterprise value, and Olympus is very strong with add-ons, and this has a very large add-on strategy for small founder-owned businesses to just be tucked in, and they'll continue to grow that business upwards of, as they always do, upwards of 100 million of EBITDA plus by the time they exit. So really good deal for our client, and it's performing incredibly well. The reason why I like it touches a lot of the themes that we were talking about in the sector, hot sectors. So it touches on reshoring, it touches on just the general fact of building. Fits in the data center space as well, because they help with physically moving a lot of heavy equipment around. So that's my favorite.
Okay, it sounds like a winner. Stephen, favorite portfolio company?
So it's hard for me not to be excited about our most recent acquisition, which we closed on here a few weeks back, which was Logistec. So Logistec is a business that provides services for the marine community and industrial companies across bulk and break bulk and container cargo, as well as a range of environmental services, including the renewal of underground water mains, management of contaminated soils and materials, and site remediation. So an interesting and business for sure, and one that we took private off the Toronto Stock Exchange for a value of 1.2 billion Canadian dollars. It's an investment that I think really fits with Blue Wolf's track record of success in the industrial area, and with our commitment to North American industry, in line with our reshoring thesis. And just to give you some sense of kind of what we anticipate, and this is publicly disclosed, we anticipate 200 million in future investment to drive growth. And so it's one that I personally am very excited about. It's been really a pleasure watching the team here work on it over since joining Blue Wolf.
Okay, sounds like a great deal. Thanks for sharing that. And Nadim, final word on the program?
Yes, I don't have a favorite deal or portfolio company, but if you're giving me the final word, David, I just want to say that I'm happy to hear the optimism and cautious optimism from the part of the panelists. I think it echoes what we're hearing, and hopefully it translates into better conditions and more deal flow in 2024. So I'll just leave it with that.
It's open.
Okay, so I'm afraid we are out of time. I'd like to thank everyone for coming, all of our attendees. Particularly, I'd like to thank our sponsor, SBS by Bain & Company, for making the webinar possible. I'd like to thank our speakers for doing a great job with the program: Clay Bryan of B. Riley Securities, Daniel Gajewski of Lazard, Stephen Madsen of Blue Wolf Capital, and Nadim Malik of SBS by Bain & Company. Everyone, enjoy the rest of your day.
Thank you all.
Thanks, everyone. Bye-bye.
Thanks, everyone.